The index is not funded based on price, it moves based on position size. Inside of here, this whole pie makes up 100%. If Apple is up and both of these are down, you find a balance. If Apple is up and then Nvidia is up, the ETF will probably be up. If Microsoft is down and these two are up, it'll probably be up. If Apple is down and this is down, then the fund will probably be down. All right, family, so this for my beginners, right? One of my things is I want to show you how index funds really work, how they can benefit you, but you need to understand how they make money and how they lose money, right? So in this video, we're going to break that down. We're going to give you a full description on how index works, how you make money with them, why you lose money with them, how they operate, because I think that it is a great tool for investors to use if you want to take off some risk off the table. Some great index funds and ETFs out there for you. This can truly help you mitigate the risk, which means take off some of the risk while you get some great returns. So we definitely want to dig into that, man. Remember, this is for my beginners that really want to lock in onto this game. So before we get into it, man, I want you to like, I want you to subscribe. Also, I want you to get in the chat and tell us how can we help you. Remember, our goal is to help you build legacy through the stock market, y'all. Let's go. All right, so today we're gonna talk about like how index funds really work. So if you don't know, an index fund is a collection of stocks on an index, which be the S&P 500, the QQQ, things of that nature. But ETFs work the same way as well, right? I would call it a basket of stocks, right? And with the ETFs, the index funds is a basket of stocks from the goal is to achieve a specific goal, right? An end result using stocks or companies that are similar, right? You may have a dividend ETF. You may have a growth ETF. You may have the S&P index, which is the VOO. You may have a world index, which is VTI, right? You may have a technology ETF. You may have a quality ETF, a value ETF. All of these things are, the ETF is designed, or the index fund is designed to have a group of companies that work a certain way. And being that they are combined like that, the goal, the objective is to get you a solid return. Right, but it's a collection of stocks and it doesn't allow you to invest in one stock. So what I want to do is I want to show you what an ETF looks like, index fund looks like using, let's say, 3 stocks, right? So in this ETF or this index, they're going to use them interchangeable, right? You have Microsoft, Nvidia, and Apple. So in totality, this is 100%, right? And so this ETF is broken down, or this index fund is broken down. Remember, they're interchangeable. So an index fund represents an index, the Dow index. The S&P is an index. The NASDAQ is an index. A ETF would be like SMH, which is about a sector, right? Which is semiconductors, or XLF, which is the financial ETF. So there's indexes, and then, there's index funds, and there's ETFs, but they all are built similar, right? So in this one, we're gonna have 3 stocks. I won't have a lot, just 3 stocks so we can make it simple and easy to understand. Inside of here, this whole pie makes up 100%. So in this 100%, every company that's inside of the ETF makes up a percentage. So in this ETF, we have Apple, right? So Apple makes up 50% of the ETF. So that means if Apple moves, it will move the index more than any other part, right? And so here you have Nvidia, makes up 30%. And then you have Microsoft, which makes up 20%. So honestly, if Apple is up and both of these are down, you find a balance. If Apple is up and then Nvidia is up, the ETF will probably be up, or the index will be up more. If Microsoft is down and these two are up, it'll probably be up. If Apple is down and this is down, then the fund will probably be down, right? And so I want to give you an idea, an example of it, right? So I wrote it right here. Let's say one trading day, Apple is up $10, Nvidia is up $5, Microsoft is down $3. How would this fund perform that day? I'm going to give it to you in dollars, but it can also be broken down into percentages, because that's how the stock market moves. If you see this, say Apple is down by 3%, QQQ is down by 5%. So it talks to you in a percentage basis. So that's saying is one day, Apple is up $10, NVIDIA is up $5 and Microsoft is down $3. So remember, we broke it down so that we can understand what? Apple makes up 50% of the fund, NVIDIA makes up 30% of the fund, and then Microsoft makes up 20% of the fund, right? And so in breaking that down, here's what we know. Here's what we know and here's what we understand. So I wanted to break this down to you because I knew this was going to be essential for you. So right here, Apple makes up 50% times 10. So that means Apple has moved, so this is $5, right? 50% of the fund times $10, it comes out to be $5. Now, next on the list is NVIDIA. 30% of the fund times $5 comes out to be $1.50. Remember, we seeing how the fund moves. Remember, these have to be, and to do this, you break it down into percentages and you'll get it. Right, now watch this. Microsoft is down 20%, but because it's 20%, that means the fund is negative $3. Okay, hear me here. Okay, we watch this again, right? Apple, 50% of the fund is up times $10, times 10, it gives us what? $5. NVIDIA, so it'll be 5, right? It's 30% equals $5, right? And that's comes out to be what? $1.50. And then Microsoft, 20% is down $3, which comes out to be what? 60 cents, okay? Remember, that's based on that 100%. So that tells us in a day, if we break this down, 5 plus 150 minus 60, that means in this day alone, this ETF is up $5.90, right? And what we're doing here is we're taking the percentages and turning them into dollars because the market is based like that, right? And so when you have, so like, let's think about this. In my account, I'll show you my account that I got in my Freedom Index. I have Costco. I have NVIDIA. I have Meta. I have TPL, Texas Pacific Land. And then I have Williams and Sonoma. Right? Now, watch this. The most expensive one is TPL. The next one is Costco. The next one is Meta, and then Williams and Sonoma, and then NVIDIA. But watch this. The index is not funded based on price. It's funded, it moves based on position size. Position size is a key factor. I have the least amount of shares in TPL. I think I have about 75. For the NVIDIA one, I think I have maybe 600. I think for Meta, I may have 200. Costco, I think I got 150. And then Williams Sonoma, I think I have 150. I have to look at my phone and see, right? Now watch this. Before that, I had FICO. Now for FICO, I had 200 shares. It weighed my portfolio down. So what I did was I got rid of FICO, right? I got rid of FICO and immediately, because of the price, I had 200,000 locked up, almost 300,000 locked up in there. What happened was with FICO, when I took it off, it immediately gave my portfolio a bump because it was price heavy, not because it was position size. Now, watch this. If I sold my NVIDIA shares, because I got so much, I think I finally turned positive. You can see it's up a little bit. It's up more. My Costco. So NVIDIA, while it's not the it's not the costliest one, position size, it will go 1, it will go 2, it will go 3, it would be tied here, and then this would be the last position. And so watch this. NVIDIA will actually move my portfolio because of how much of it I own, right? So what I need, NVIDIA, Meta, I need them to move a certain way. So right now, I actually have like a fund, right? But also, I want to say this to you too. When you own in the fund, you don't own stocks in the fund. When you own a fund, you are putting your money in the fund, and the fund is spreading your money out. So if you put $100 in the fund, 50% of the money gonna go to Apple, 30% of the money gonna go, so $50 of $100 will go to Apple, $30 of it will go to NVIDIA, and $20 will go to Microsoft. That's how a fund is broke. You don't own Apple, NVIDIA, and Microsoft. You don't have no ownership in these companies. You're investing in the fund, and you're paying the fund what's called expense ratio, which should be somewhere between 0.3 and 0.15, right? You're paying the expense ratio that to manage that money for you. And then every year what the fund gonna do is they gonna swap around. So next year, once a year, they might say, hey, we're gonna switch some of this and put it in NVIDIA, and we're gonna switch some of that and put it in, we're gonna take some of Microsoft and move. So every year the fund gonna move some money around for you. You feel me? So I want y'all to just understand this, man, when it comes to investing in ETFs, when it comes to investing in index funds, this is how it's broke down. What you gotta go do now is see how many funds, how many companies are inside the fund. And they can have anywhere between 30 and the S&P got 500 in it, right? So you gotta figure out how many companies are inside of the fund. Now look, man, I hope you learned something from this, man. Definitely lock in, comment in the video, in the comment below. Let us know how we can help you, get better. It's your boy, the Wall Street Chopper. Make sure you like, make sure you subscribe. Man, salute.